In any market, price moves from supply zones to demand zones and back over and over again. If you learn to find the zones, you can get into decent trades precisely at the point when banks start to place their trades. That's why today I'm sharing one of my favorite smart money strategies using supply and demand areas in combination with psychological levels. You know the drill. Like, subscribe, and stick around for the full video. Demand zones form when banks place a large number of buy positions. This creates an imbalance and results in the price aggressively moving higher. These are the support levels of supply and demand trading. Supply zones are points where the banks place a significant number of sell positions, resulting in price aggressively moving lower. These are the resistance points where price could fall. So if price returns to a certain supply and demand zone, it has a high probability of rejecting these areas. Now let's be clear, it takes time, practice, and experience to identify the best supply and demand areas to trade. Here's my process. You already know that supply and demand zones are formed when banks are placing large quantities of orders. Well, on a price chart, a sharp rise or a sharp decline appears in price. These are the first signs that smart money are active. Identifying market imbalances is the first step to finding supply and demand zones. Market imbalances refer to big price shifts in one direction. To locate demand zones, you look for a fast impulse move. The key point to remember while finding the market imbalances is to keep an eye on big green candles. You can identify these candles by their long bodies with little to no wicks. Once you have identified the fast impulse move, it becomes a lot easier to find the base of the zone. You find the most recent down candle before the impulse move and place a line at its high price, and a line at the most recent low that formed at the source of the move. It's a slightly different method to draw the area compared to my previous videos, but I'll explain later why I chose to use this method instead. To find supply zones, first, you're looking at fast declines. Sharp declines occur when supply comes into the market, which happens when the banks sell. Again, you look for big red candles with long bodies and little or no wicks. In theory, price has a high probability of reversing once it returns to the source of the decline. You then find the most recent up candle before the sharp down move and place a line at its low price, and another line at the most recent swing high that formed at the source of the move. Human emotions play a part in the price action observed in the markets. Many traders prefer to set their buy and sell orders around round numbers. It's not that common to have an order placed at $60.12, for example. No, instead we like to work with round numbers, and that's why these numbers are psychological levels that have breakouts and big amounts of activity attached to them. To plot these round numbers, I first add on TradingView the horizontal grid lines. Then I simply adjust the right margin and play with the scale, depending on the market I'm trading. These psychological levels are perfect for identifying high probability supply and demand areas. A supply zone, in combination with a psychological level, is a high probability area to initiate a buy position. A demand zone, which includes a psychological level, again offers a low risk, high reward sell situation. We are looking at crude oil. I prefer to analyze higher timeframes and pinpoint the entry on lower ones. On the daily timeframe, I see a demand area. I see this big strong lineup of candles moving up, candles with long bodies and small wicks. We then identify the origin of the price movement, the last bearish candle before the rally. We also adjust the scale on the right to have a $1 grid to find the round numbers. Our demand zone includes 3 psychological levels at $64, $63, and $62. We don't know which one will hold. You can set a limit order at one level inside the zone, the aggressive entry, or you could wait for a price action signal to confirm the rejection, the conservative method. I prefer the second approach. I look for pin bars or engulfing candles to form inside a zone, rejecting a psychological number, and then I enter. Now, we determined our value area. Let's see if price returns to it. We move to the 15-minute time frame to pinpoint the entry. This is the signal. A pin bar candlestick forms right after price enters the zone and rejected the $63 round number. This is our signal to buy. Stop loss below the demand zone. Take profit as usual, depending on recent market structure. I'll set my first target here at $72 at this potential supply zone. And the second target around the $78 mark, again below this other supply zone. We move to Bitcoin on the 4-hour time frame. I see this potential supply zone after this aggressive down move. The strength of the move is very important. The stronger the price moves away from a zone, the more out of balance supply and demand are at that zone. It means a heavy order is placed by smart money. You also must analyze how far the price moved away from the supply zone. The longer the distance price moves away from a zone before returning to that zone, the better. First time retrace to the supply zone is the strongest to enter. Always make sure the zone is still fresh, which means that after the initial creation of the zone, price has not come back to it yet. Each time price revisits a supply zone, more and more previously unfilled orders are filled, and the level is weakened. Okay, now let's wait for a retrace back to our zone. Observe we have 3 psychological levels inside the area. So again, we'll wait for price action confirmation. Here's the rejection. An evening star candlestick formation. Stop loss is placed above the supply zone and will target this demand zone. Let's move to stock market. Tesla. On the hourly time frame, we find the potential demand zone. We draw the zone based on the last bearish candle before the sharp rally. Now we'll keep an eye on the future price movements to see if it retraces back to this demand level, because in theory there should be many buy orders waiting to get executed here. I set a $10 grid on this market and observe that our demand zone includes 2 round numbers. Now we'll wait for a confirmation because we don't know which level will hold. A good idea for confirmation is to wait for the first reaction on the round number to see if the price is strongly pushed away off that level. I also want to see signs of weakness in price action, momentum loss, decreasing candle range and body, and lower wicks on the candles when price is inside the demand zone. Okay, price found support at this psychological level, inside the zone. The stop loss is placed just beyond the extreme of the zone. The take profit is the next major supply level, which would be right here. So I'll set my target a few cents below this area. The risk-to-reward ratio on this trade is quite good, around 6. Like I said before, you can be aggressive and use limit orders. It's a decent way of trading supply and demand, and you can be quite successful with it. The problem is that a limit order entry provides no confirmation that price will reverse from a zone. You will blindly place the order at the edge or inside the zone and hope that price reverses. This would not be a problem if all supply and demand zones worked all the time, but they don't. Price blasts through zones frequently, usually without stopping. With a limit order entry, you cannot avoid this, so you'll end up with many losing trades. With a price action entry, however, things are different. It's better to find a supply or demand zone on the higher time frame, wait for price to come to this level, and see any acceptance or rejection from this zone on a lower time frame. You look for any reversal price action signal on the lower time frame, rejecting the psychological number inside the zone. And yes, you'll have a delayed entry, sometimes not even inside the zone, but in the long run, price action confirmation will save you from many losing trades. We trade euro-dollar on the hourly time frame. This would be my minimum time frame to find supply and demand areas. I see this supply zone right here, which had a huge drop consisting of multiple bearish large candles. This supply zone also aligns with the current trend, which is down. So another tip would be to trade zones in the direction of the main trend. If the trend is down, you look for supply areas. If you have an uptrend, you search for demand zones. We have 2 round numbers inside the zone, so as usual, we'll wait for a clear rejection inside the supply zone. Let's pinpoint the entry on the 15-minute time frame. Just as expected, price found resistance at the first round number inside the zone, forming a pin bar candlestick. This is the confirmation I needed. Stop loss on the other side of the supply zone. Take profit a few points below the next major demand zone, which would be here. A risk-to-reward ratio of over 4. If you found value and learned something new, leave us a like. This way we'll know if you'd like to see more videos like this one. And check out our Academy program if you want to further level up your trading. Until next time.